Ladies and gentlemen of the crypto space, we're live on a Friday, November 17th at 11:35 a.m. Saw some early adjustments in my camera. We are good to go. We are ready to see what's going on in these markets. Let's pop it over to the main screen because there is a mystery afoot. Oh, I am on the wrong network to get optimal bandwidth. That's unfortunate. All right, we're going to do the best we can. We'll see if bandwidth drops. I don't think I'm really going to swap networks midstream. That produces unpredictable results. Short time frame is what a lot of folks think about mentally when they're inspecting markets, and I'm cursed with a need to primarily inspect high time frame nowadays. I have a very long-term time horizon in mind when I'm thinking about my capital management, my portfolio, and that is what I encourage everyone else to look at. Target 2030 if you could prepare in your 20s for 23, and you can prepare for when you're 30, 7 years. 2030. You see my point there is 2023. So that's great. So maybe my time frame is actually best suited for a relatively young individual. And I myself, even at 40, I'm like, all right, fine, 2030, 47. And that is a very acceptable time frame for even a person of my age. So such a time frame of 4 hours, you're not really going to get a sense of what the system is doing. This is Ethereum, dollar denominated. You're going to see aberrations, you're going to see deviations from trend, you're going to see a variety of moving averages, and you see breaches all over the place because things fail, things mean regress. You're not going to get the perspective that is necessary to find or to sustainably engage with markets. So even on the daily is useful to a degree, but it's not going to give you a lot what you need from a moving average perspective. Moving average mean regressions are much more meaningful on high time frame because when you'll see a move occurring on the daily, it might not be such a remarkable move on a longer time frame. Albeit the daily gives us a sense of what we're going to do intra-week. As of right now, we punched through the daily TWAP. It was a nice run up from more or less support of this ascending triangle to resistance. The TWAP almost got there. We're below the TWAP, and we closed. Yesterday, we kind of closed below the TWAP, and as you can see, we have confluence today with a lower low thus far, suggesting a continuation to the downside, likely a mean regression to the 200 SMA or the 50 SMA on the daily. Zooming out on the weekly, which is contradictory to that potentiality of another retest of support, we are still above the 100 SMA. Now, this is actually the moving average that catches my fancy the most. We broke down last against the 100 SMA on the weekly in May of 2022, a year and a half ago. That's pretty cool. This is the first time since May of 2022 we are interacting with the 100 SMA whatsoever. And we punched through it. We punched through it cleanly to the point where this is literally a retest today, Friday, November 17th. So let's see what happens over the weekend. I obviously would favor a breakout, a retest holding support, and let's trend in the 1900 to 2000 range for however long it takes to potentially move to the higher high, because that would be consistent with the trifecta of bullish confluence. So thus far, we have one part of the trifecta of bullish confluence in place. We have the retest, but we don't have a confirmation of the retest. Could still see invalidation of the trifecta. And if we zoom out to the monthly, we could say basically we just haven't broken to a new high yet. We have interacted with this resistance level that was set in August of 2022. 1, 2, 3, and this is our fourth time in November. That's basically the perspective on the monthly. There's no reason you can't have mean regressions, and a mean regression to the time-weighted average price is totally more or less in line with the ascending triangle. You're not going to see necessarily invalidation, especially with the time-weighted average price and the 50 SMA just below it. And you could obviously draw this a little bit lower. So there's plenty of wiggle room with regard to charting. especially trend lines, which don't have the biggest value. It's the lowest on the value levels are really the biggest value, in which case the resistance level of this ascending triangle is a meaningful value level. I mean, this is a nice structure to see. Obviously, it's a flag of sorts. It's coming off a pole that's descending, so this is a bear flag, but this is an ascending triangle. This is a breakout of the monthly time weighted average price. This is a retest over a 3-month period, and it did almost produce the higher high as compared to the breakout. So this is a very interesting structure from a variety of angles. In charting, you look for confluence, multiple pieces of information suggesting a particular directionality. In this instance, things look decent, but we have to inspect global macro. You could always have a global macro rug pull. I'm not going to digress too much on macro today. But generally, we are trending in the right direction from a DXY perspective. We're trending, in the right direction from a Fed liquidity perspective. China has been cranking out a lot of liquidity, debasing its currency. I expect Britain to do something similar with a very large negative producer price inflation, or was it retail sales, like minus 2.7% year over year. So that's obviously deflating. It's a negative number. Bonds caught a good bid this week, treasuries particular, long end. So collateral prices are up marginally. Mike Howell indicates it most granularly that there's a trend of increasing liquidity into the system heading into 2024. So we're in favorable conditions for these assets that are highly liquidity sensitive to continue appreciating into 2024. I guess the most notable thing from a short-term time horizon is that these intra-week moves, they shake people out. The trend is decidedly upward, and you see that from a monthly perspective, where you have higher low, higher low, higher low, higher low, higher low, higher low, and a resistance level. So it's very consistent with an ascending triangle structural formation. Everything did very well. Lots of altcoins did very well. Atom was over $10 for a bit. Stargate was punching resistance. I mentioned Stargate because I have recently inspected some of the returns over the last couple of years, and I was surprised to see it produces over about 15+% APR, which isn't really talked about, and it's not highlighted much in their user interface. They mention a base return, but in actuality, when you're doing stake claims, it's about 15+%, which is quite remarkable because that's cash flow from the protocol. And that is not consistent with other types of, it's not an Oracle system, it's a cross-chain system. But it's an interesting source of cash flow that has the potential to scale significantly. And we've heard great news about integrations, especially activity, consuming them as a piece of infrastructure on AVAX. And I have a high opinion of what they're doing from an investment standpoint, particularly the potential cash flow that they can produce from a high time frame perspective heading into 2030. The entire space goes 10, 15, 20 trillion dollars worth of on-chain liquidity, and that's going to be a lot of revenue for the protocol. Would see nice appreciation of the principal and likely a continuation of these interesting APR values. So if your principal goes up 10x and you're getting 15% of the money, that turns into a nice cash flow investment. Gold has remarkably hovered below 2,000. It's just so pushed around by the paper market. Nothing really else I can mention about that. Gas finally caught a little bit back up, but it is still in bearish territory below the weekly 200 SMA. Same with oil, caught a bid off 72. What you want to see is oil and gas roll over, which would be indicating the real economy is in trouble with regard to consumption, with regard to credit being frozen, and that would take upward pressure off of the dollar further, and obviously the dollar is already rolled over to a degree. Let's zoom out and get the perspective on the dollar. This is probably it's literally just the DXY is a nice aggregate representation of a lot of macro that puts pressure on crypto markets. Equity markets are another story, similar but not necessarily the same story. But if you see crypto rallying, it's because basically the dollar is rolling over. So that's a nice, easy way to get a sense of where the hell we are with regard to crypto. So this is the most meaningful perspective. Rolling tops. So you had a breakdown through the monthly time weighted average price. The breakout failed retest, but we're still above the 10 SMA. That's the monthly chart, which means we'll see what happens in December. So it takes a month or two or a quarter to really get a sense of what's going on. You need a couple of candles to establish confluence. Is this a successful breakdown? Surely a failed breakout. There is 13 days left in the month. Maybe it wicks and it does hold support on the time-weighted average price, but that does indicate that the time-weighted average price was soft. It wasn't hard because a wick pushed below it. So you'd wait for next month. Next month, if you have continuation above the time-weighted average price, unfortunately, you do have a confluence suggesting the retest is sticking. And then you're looking for the higher high, which would be a retest, the trifecta of bullish confluence, which would be a scary picture to paint for liquidity sensitive risk assets. If you see the breakdown, on the other hand, that basically indicates significant weakness in oil and gas. That is what drives a good part of dollar demand globally, is energy. So that'd be scary from the real economy perspective, and that would be bullish from a global liquidity perspective, because as the dollar comes down, foreign fiat has more value, has more purchasing power, and it's generally representative of increasing liquidity conditions globally. Now, obviously, increasing liquidity conditions globally are countered by the respective economic situation. How are they doing with regard to interest rates and balance sheet capacity spread around the planet? It's not just one pressure in the system, dollar coming down, but other factors are critical to assess, which is what Mike Howell does so well from a global perspective. He says it's about $170 trillion worth of liquidity in the so the real economy and the financial economy. So he says there's $170 trillion in the financial economy worth of liquidity, give or take. And for all ways you can think about it, any way you could spin it, it looks like that liquidity has to increase over the coming years, particularly considering the debt construct. So if there's 170 trill, 190, 2025, 100, 210, 220, 2027, that's a lot of liquidity, even though a lot of it goes to servicing things in the real economy. The potential for seepage of that liquidity into investments, potentially lucrative digital enterprise investments, is quite meaningful. That's why we look at these investments, because these are enterprise in the financial economy. These aren't enterprise in the real economy. And these are literally dealing with the global liquidity system. And these liability printing systems have a potential to play a role in that global liquidity construct, especially from a permissionless standpoint and a regulatory arbitrage standpoint. Bitcoin looks like it was holding support. Was it the daily TWAP? Yeah, we thought it was going to hold support on the daily TWAP. Let's zoom in. Because the close yesterday was very nicely above, but thus far has been pushing below. So this is an interesting territory with regard to a reversal from where we are versus a continuation to the upside. This construct over the last 1, 2, 3, 4 days is expressive of softness of the time-weighted average price. It's not a hard support on it, much like we had back here in last week, November 23rd. That's the early in this month, the November 4th to the 7th. This is a much expressive of a much stronger support. This is a much weaker support. So this is a bit of information that suggests we probably push below the daily time weighted average price for a period of time. Clearly, we're significantly deviated from moving averages to the upside. And this is where mean regression comes into play. And this is the weekly time-weighted average price, which is a relatively short-term mean regression. If it occurs, 29,000 is totally in the books. It's not too much. What kind of percentage is that? You're talking 7,036, double-digit percent. But in Bitcoin land, in crypto land, double-digit percent is not the end of the world. You have volatility to the upside, triple-digit percent, that compensates with destination in mind. Path, there's great potential for short-term to the downside. Destination, there's obvious potential for the upside. So the question really is how you engage. Do you want to capture that additional percent and there's a risk associated with that, or do you just accumulate assets? And that's why we do what we do, continuing to accumulate assets from cash flow using these on-chain enterprise. Ethereum-Bitcoin might be an interesting chart. So towards the downside of support on the most monumental triangular compression you can inspect technically, but it's right around the 200 SMA on the weekly. Let's zoom out to the monthly. 50 SMA on the weekly, 3-month, below the time-weighted average price. What have I said about the 3-month time-weighted average price? So on average, in 3 months from now, the price of Ethereum relative to the Bitcoin price will be higher. That's what this trend suggests. So right now, if you are purchasing Ethereum, you are purchasing at a discounted price relative to Bitcoin over a 3-month average. And that feels about right. Ethereum has lagged the Bitcoin price. Bitcoin has outperformed relatively, and that obviously is seen in this chart. But historically, Ethereum does not lag the Bitcoin price for an extended period of time. Bitcoin moves, and then obviously Ethereum gets the action it has historically seen, and then it catches up really quickly. And that's kind of where we are. On a 3-month time frame, this is very interesting. That means in 2024, we'll see completion of this triangular compression from a structural standpoint. This is really a good part of what's going to play out, and it's going to drive the entire conversation in 2024, the Bitcoin conversation versus the Ethereum conversation. And that would ruffle a lot of feathers if Ethereum significantly outperforms Bitcoin. So the implication from a measured move perspective is the aperture. So we're talking about okay, so the implication of this chart is actually pretty wild. The implication implies the flippening. That's crazy. So if this breaks out to the upside and plays out from a measured move perspective, technically, it's the flippening. So Ethereum would be 1.4 times the price of Bitcoin, would be a 2,000% appreciation from breakout, not even where we are, and 2,000% from where we are to 20x on 2,000 would be a $40,000 Bitcoin Ethereum price. What's most fascinating about that is this does not consider Bitcoin appreciation. That would be Ethereum making this measured move if Bitcoin remained constant in price. So I don't think that's going to be the case. I think Bitcoin will continue its appreciation significantly if Ethereum is doing this. But this would be quite so the percent appreciation Ethereum denominated would be this is Bitcoin denominated. We don't have the triangle compression like this on Ethereum USD denominated, so we can't really get a sense of where this chart is saying Ethereum is going from a dollar price, only from a Bitcoin price. quite fascinating what could play out in 2024 as the federal government is heading into $10.8 plus trillion worth of debt refinancing. And it's going to be the most epic liquidity tsunami that these crypto markets have ever seen. It's going to make 2020 seem small. It's going to make there's just no comparison. Tapsy's in the house. One curious few. Paul, a pleasure. Killis, thank you all for joining. FXS briefly broke above this level. This is quite an interesting level. Horizontal line, right about here, give or take. So that's a very interesting level, and we're in retest zone. Notice every chart is very similar from a breakout standpoint. Everything broke out from a meaningful level. And right now, everything is basically retesting those levels. So that level on FXS is about $7. We're about 10 cents above that level. It's obviously give or take, plus or minus. But this is something that looks promising. You know, folks, and the perspective that we have is just from long term. Most folks that are listening to the stream and most folks on Discord have FXS positions dating back to launch. I think the launch was before 2022. So launch was in what, either late 2020 or sometime in 2021. But FXS has been basically a horizontal chart from launch, which is quite interesting. Obviously, we have big aberrations to the upside, and this is on frac swap, so it doesn't have the full history. It got much higher, but this is promising for a start. That's what we're trying to assess. Folks that are new to this space are like, oh, it went up and it's going to come down, but this is the way us folks that have been in these markets for years are trying to get a sense of, is it starting? Are we starting to see higher highs and higher lows? And this is our first retest. We've had significant moves up, hundreds of percent move up on many assets, and this is clearly the expression of that move off the bottom for this asset, and we're now going to assess if there's going to be potential continuation to the upside, or we'll have to wait into 2024. Prisma getting hammered as expected to a degree, down to 71 cents. This is a chart that I expect to be very horizontal, if anything. Let's see how Aura is doing. I know a lot of folks like Aura. 170K. So Aura move off the bottom. This isn't enough data. I have Aura over here on TradingView. Here we go. 96 cents. Zoom into the 4-hour. So we have a move off the bottom. It looks like it's trying to hold support. So we had a break of the 200 SMA, and we're retesting the 200 SMA, clearly from a 4-hour perspective. Nice wicks below have been carried, closing well above. On the daily, it looks like we're trying to hold support on the 100 SMA. That's the expression. That's pretty interesting. So as you can see, the rhythm and rhyme of all charts is the breakout and a retest on either a level or a moving average. I wouldn't say trend lines are significant at this point in time. Notice on the weekly, time-weighted average price is that support level. So we had a breakout above the weekly time-weighted average price, and we're now trying to hold it as support. Look at that spinning top. It's probably going to close a spinning top at this point. And that is an expression of indecisiveness of the market. But clearly, if Bitcoin starts to rally, that gets everything else rallying, and then this support level solidifies, and at least it's a breakout, a retest, and then we're looking for the higher high for the trifecta of bullish confluence. VIX down at 13. How about that? Down 4%. Volatility is low. Look at MOVE coming down a little bit as well, down at 116. Notice it's coming down. You got to zoom out to the 3-month on this very, very important chart. And we are still way above the time-weighted average value. It's not even a price on this move indicator. So they have yet to get control over the stability of the global collateral pool. and the pristine collateral of the United States, because if they did, this thing would be rolling over. And if this thing rolls over and the dollar's rolling over and collateral's rallying, sure, plenty of things could break in the real economy, but global liquidity is going to go sky high, and we might see some serious decoupling between equity markets and crypto markets. That's probably something I'm expecting to see at some point, especially if interest rates remain high, credit remains relatively frozen. I expect to see a moderate extinction event for good parts of equity markets over time. Now, when I say this, you got to imagine the time frame I'm thinking from. Like heading into 2030, we have 25% of the equities market just go bye-bye, and the entire system gets that much concentrated, that much more concentrated, and that's probably the case for regional banking as well. It gets concentrated over time. The strong survive, the weak are just cold, especially if interest rates heading into 2030 go higher, low, higher, high. 2021 for FXS. Thank you. Dan, what do you think of your fair value of FXNs? It's all technical. Obviously, narrative. I think it'll catch a hell of a bid because Aladdin is a heck of a meme, heck of a network, suite of products. I mean, there's a lot of code that goes into that suite of products. So that'll have a lot of attention during highly bullish market conditions. Let's take a look at the technicals. I don't have my trading view technicals here on CoinGecko. It's very important to observe that this is a very large move off the bottom. There is no reason to expect, or to rather not expect, further continuation to the downside. There are no meaningful levels of support. This is a couple of days. It's a fraction of a month where this move occurred. And this is not an aberration. This is a complete deviation from the average. So just be cautious. This is a brand new asset. No, that means is entirely uncertainty. The expectation has got to be to the downside from here. It has nothing to do with the narrative. In a positive sum environment on Ethereum mainnet, this thing could go significantly higher. There's no history here. That's the complexity. And that's why we're looking at Solana and comparing it to like 2020 Ethereum. And we're looking at like Cosmos Hubs and we're comparing it to like 2020 Solana. When you have a history, you get a sense of where things are heading. This is first time around. So you have no levels for market actors to act upon. So there's no precedence that has been set, which means there's maximum risk, max risk, max return potential on the table here. My expectation will be to the downside, and Cleve is quite interesting from a cash flow potential. I would love to see Vote Rentals come online for Cleve. That would be interesting. A lot of folks look for the exuberance, and you can catch many trades, so on and so forth. And you see a lot of folks getting excited as liquidity started to roll around in this space once again for the first time in 2 years, everything coming off the bottom. But my general sentiment remains the same. There's not many high quality investments in the space, which is why I bought a little bit more of Stargate. Maybe like if you're able to catch like a seed round or early stage investment, but it's slim pickings, something that you know from your experience is going to be a type of winning product. And that is just how I'm proceeding. And it's a lot of what we've talked about on Discord for the last 2 years. We're positioned already. And what you're doing is taking maybe some of that cash flow over the years and maybe introducing some external cash and trying to get something new. What's new? What's new? I don't know. I mean, Prisma's new, but It's anything that's first time around. You have no precedence to go on, so you don't know where things are going to head and settle with regard to their overall utility. Um, so what is that? That means we're in like a 2020 environment where you have a lot of uncertainty, max risk, max reward, volatility. We have yet to see a positive sum environment on Ethereum mainnet. All of this activity that we've seen, it's basically zero sum, which means zero stablecoin inflow and less stablecoin outflow, and maybe like 0.25%, which is doesn't even count. So all of these 100% moves on various assets that you probably see and pop up on your X timeline. It's just a hot ball of money within this emerging market. It's not capital flowing in. This isn't even a move yet. We haven't had any action. Take a peek at total 3. We're not even at the average value of non-Bitcoin, non-Ethereum market cap. Nothing has occurred yet. There is no deviation to the upside. Basically, any acquisition of smaller enterprise, commonly defined as altcoins, is below what the potential price would be in a positive sum environment. It's going to be fascinating. Like literally the base case of many macro investors, Dan Tapiero, is 10 trillion by 2030. So 10 trillion would be right about there. You do have so this is why it's so imperative to have time horizon and position size in mind. Do you have any idea if this space expands to $10 trillion worth of value? You know what kind of positive sum environment it's going to be? You know what kind of capital flows are going to come in chasing that kind of appreciation? You thought 2020 was wild. When this thing has 2, 3, 4, 5, 6, 7, 8, 9, $10 trillion, it's just going to be an absolutely insane environment. Absolutely insane environment. Do you think S&P will make a new high in the next 6 months? Does it matter? Where are we now? Let's look at it technically. Look at futures. Does it matter if you're like an S&P investor and price range, current price, makes a new high, 10% on the money? That's cool if you throw in $1 billion into it and you make 100 mil. Doesn't mean nothing if you throw in a couple of $100, couple of $1,000, or you're DCAing your 401k. So that's a very pertinent question considering current market conditions. But where's the return? Where's the value? Where's the potential to really mean something for a smaller size portfolio? 10% does nothing. I don't really care at all if S&P moves 10% to the upside. It's just boring as shit. The only reason this is propped up is because the entire system is dependent on it for retirement and all these 401k flows that are just dumping money into the Magnificent Seven. This chart doesn't mean anything really significant to me. If anything, it's just a proxy for the need of liquidity to continue to expand in the system at a predictable rate in order to continue to just be able to service debt outstanding, not and get alone finance and refinance and roll over debt cyclically as required on about a 4-year time basis. NASDAQ will outperform. So I would expect NASDAQ to print a higher high before the S&P. But even NASDAQ, I don't give a shit about. I mean, is this what? This is not what we're investing in. This stuff is boring as shit. Price range. I mean, you print the higher high, you're talking about the same thing as S&P, 10, 15% from here. That does nothing for a portfolio when you talk. Everyone on your X timeline is hot about assets that are moving up a couple 100%. So That'd be nice if that actually worked. Nope. I want to do this. Price range. I mean, X is off its lows 557%. These are much more interesting assets as compared to anything those stupid ETFs and meat space have to offer. Um, but you're going to get, well, here, check it out. Let's see if we can get a fib retrace. Upside down. Yeah, this has more to go. Much more to go. This is a big extension. Look at this average price since launch. Maybe it's just folks trying to determine price discovery, what the actual price is, but it's got more to go. Portugal in the house, much pleasure. Killis, thoughts on timeline of total integrations to mainstream, crypto NFTs, deeds, driver's licenses, blockchain, 10, 20 years, 30 years? I don't know the way it's going to play out. No one does. But it's just superior to have some sort of utility, public utility where data is stored that's verifiable and potentially immutable. The problem is the best technology, one, isn't always a great investment. That's a rule of thumb that we've talked about over the years. Two, status quo is immobile. You go to like you're the clerk's office for local government, city hall, and they're not changing their damn technology anytime soon. But then again, talking in the 20, 30-year time horizon, you should expect systems to change to a degree, at least at the margins, or at least things starting to change. I don't see it from an investment perspective, but ultimately, a lot of this stuff will end up in a different type of storage medium. You know, resiliency, centralization is the absence of resiliency. You can have backups, but the concept of decentralized storage is a game changer from a societal level in the management of information. So, the world's going to be a different place, Killis, in 10 years' time. In 30 years' time, the world will not be recognizable. And thankfully, I'll still be young and sprout at 70 years old in 30 years from now. So I very much look forward to what has yet to come. Daniel, hello. Wondering which federation is best for cash flow with 100K. It's for you to answer that question. And it's not necessarily which federation per se. Why do I say that? Because it's all about money. And it's all about interest rates and APR. It's also about potential growth. But the point is that 100K producing 15% of the money means you're making 15 grand a year. Obviously, you're also going to benefit from appreciation, potential appreciation of the principal. So these are the speculations. So even with ownership and investing in cash flow, dividend investing, you still have great potential in crypto markets, in my opinion. One, if a protocol survives and if a protocol thrives. A 5x, 10x on 100K puts you at $1 million. And if interest rates continue an APR of 10, 15, 20%, now you're producing 100, 150, $200,000 a year. So for me, those are like good targets for 2030. Even traditional macro folks are talking about a 10x in total liquidity in this system by 2030. Good old 10T from Dan Tapiero. So 10x's are kind of perverse. They're sought after, called 10 baggers in TradFi in meat space, but 10xers over a 7-year time span heading into 2030 is kind of like reasonable in crypto markets. What kind of market activity did we see in 2020? That shit got frothy. And there was not 10x's, it was 50x's and 100x's. So 10x's are quite reasonable. So the characteristic to look for isn't even necessarily what's outperforming. The characteristic to look for to attach to a 10x portfolio growth heading into 2030 type goal is survivability. And what is the best characteristic for survivability? Immutability. So if a protocol cannot change and it's doing what it's doing today, it's productive today, and it's growing today, it will continue to grow in the future. And growth is not just the protocol itself as it evolves over time, but it's the federation components. So if it's doing what it's doing today, in 5 years from now, could you imagine how many new protocols are going to spin up around it, attaching to its narrative, attaching to its lindiness? That's going to be quite fascinating to see. So you're going to probably be able to answer your own question really easily. How many federations are there? How many protocols have third parties that are aggressively consuming supply and making the market relatively illiquid for certain assets? You can answer these questions for yourself. I think there's only one major federation in all of crypto, and there's a couple of what's probably definable as proto-federations. Early stage, we don't know if they're going to catch the exponential growth of the federation network. So I like the proto-federations, but certainly the core investment, as folks know with me, is the only primary federation that is clear as day. To me, it's got to be the best investment I've ever seen heading into 2030. Now, obviously, it'll drive new folks mad because how do you structure a portfolio? What do you acquire to attach to this narrative or to express this narrative, this 2030 narrative of where things are likely, more likely than less heading? And then that's a hot debate. And I know how I express it. I am a base layer maximalist, and that's okay. I have no expectation to outperform. I just want to be exposed to the core narrative from the base layer, which means I probably underperform derivatives. And that is something I understand. And that's okay. I intentionally want to underperform because I just want to survive until 2030. Because surviving in crypto markets is exponentially outperforming anything that's possible in traditional markets. S&P is a good indicator for whether our microcap investments would do multiples to the upside. Well, S&P, not necessarily in my opinion. Why do I say that? I would like to see the S&P just go freaking horizontal because my expectation is that the Fed is going to try their best to constrain liquidity in the real economy, which will constrain earnings, which means higher interest rates and good parts of the S&P just evaporate and they can't roll over their debt and they go bankrupt. And then they're recomposing into other shit out of the Russell 2000, which is also horizontal. I would love to see Russell and S&P go freaking horizontal as the world realizes we're not going back to 0% interest rates and the debt construct of much enterprise is completely invalidated as viable. And that means the real economy will not necessarily suffer, but it's going to reorganize and concentrate. The stronger companies that are better handling their debt construct will survive and thrive. Like literally Amazon's just cash. They put their cash in a bank account and they're making 5% of the money. I mean, Warren Buffett is earning 5% on what, $150 billion? That's crazy. So I expect a large invalidation of traditional enterprise. So my base case is probably horizontal-ish for these markets. Maybe a little bit of expansion just because global liquidity has to expand in the coming years. But I don't expect like insane exuberance, especially in the S&P. They're going to want to keep it up because the other part of the equation is revenues from this financial economy. The U.S. government is completely dependent on these revenues, these tax receipts, so they can't let it completely fall apart. But the Fed doesn't manage. The Fed is not in the business of actively managing equity markets. The Fed is in the business of controlling consumer price inflation, which means they need to manage the liquidity in the real economy. So the Fed doesn't want that's like everyone, us, going out, stores, businesses, mom and pop, people. That's the real economy. That's not the financial economy. So my expectation is an increasing decoupling of the real economy and the financial economy. So what can you do? You control the liquidity in the real economy, try and rope in consumer price inflation, and allow the financial economy to decouple. And look, they're going to print $10.8 trillion of fresh on the run paper next year. How is the financial economy not going to decouple? It has a tremendous amount of paper to print fresh dollar liabilities, and they're not printing one-to-one. They print in multiples, leverage the shit out of treasuries to print dollar liabilities. Hence, there's $170 trillion of liquidity, as Mike Howell talks about. But then if you look over at, how do I not have M2? USM2. Why is it up there? USM2 is about $20 trillion, and that's just small relative to the hot ball of $170 trillion in the financial economy. And then you go over to M0 and realize that there's $5.56 trillion on the planet that are used to create the $20.7 trillion worth of various dollar derivatives and credit in the United States. And all of that, including the $33 trillion worth of national debt, is used to manifest the $170 trillion worth of total dollar liquidity in the financial economy. It's all going to go up. The financial economy is going to further decouple from the real economy, and that's what's been happening since the 70s. Nathan, Lisbon, Portugal, in the house. What a beautiful country. Killis, you're always welcome. Killis, Lau, yes, you will be young and sprouty at 70. 70 years old! Are we still going to be doing this stream at 70 years old? I think so. Could be a little optimistic. Sergio, present and accounted for. Where are we with the total? So total market cap pushed above the time-weighted average price. This includes Bitcoin and Ethereum. So this gives us a good sense of where we are, but it is still holding potentially as resistance below the 10 SMA and the 3-month. This is why high time frame means something. So we're at a premium. The whole market's at a premium relative to the average price, time-weighted average price. So from a 3-month perspective, we could have literally a retrace for a month. Let it pull back to the time-weighted average price in a month of 15 days before this candle closes, and the market still looks good. The market is bouncing back with a higher low, a very confirmed higher low compared to the lows in January of 23. So that is a very comfy indicator heading into 24 and 25. Hope that helps. Hilda's in the house. Much a pleasure. Much a pleasure. So many folks have stuck around over the years. It's very comforting because all you have to do is survive these markets. In 2020, in 2030, we're all going to be looking back and we're going to be like, we were so young dealing with these systems and we had good rules. Can you imagine the rules and the stories we're going to be telling in 2030? That I could comfortably say we're still going to be doing this stream. We're going to have some really fun stories to say. And I think the easiest story we're going to be able to tell is we took a lot of risks, but we also saw that all we had to do was survive. That's an interesting thing I do with the equities portfolio. A good part of my equities portfolio, they're bankrupt. So probably about 20-30% of the companies I bought over the years are gone, either bought by other companies and merged or just bankrupt. But of the few that have survived, those are the ones that are thriving. The equities portfolio is nicely structured heading into 2030. But you expect, like, Out of 10 things you own, if all you need is one of them to wildly succeed over a high time frame, and that's how you set yourself up. So folks are like, how did you make it? How did you do it? How did you know? It's like, I didn't know. I put chips on the table for 10 different things, and all I needed to have is one of them succeed. So you don't know, but all you need to do is find one out of 10. And that's how you do this shit and set yourself up for life. DeFi, LMAO. Looking back in hindsight, going to be entertaining AF. DeFi. And the story will only mature from here because DeFi is an antiquated or short-sighted terminology, even at this point. Decentralized finance. Who gives a fuck about decentralized finance? These are immutable, deterministic credit markets, money markets, and forex markets. Deterministic and immutable. And credit markets, forex markets, and money markets are banks. That's what banks do. You folks that are playing around with DeFi, any name you could probably think of is some sort of business that in the 1980s, 1990s, 2000s, and 2010s were only run by banks. And what we're doing is we're VC investing in startups that are probably definable in meat space as non-banks doing banking, and you know stuff like PayPal and Venmo, and that's the concept because before PayPal and Venmo, you had ACH and wire transfer, and that's how you move money around. So that's non-banks doing banking things. This stuff that we're doing is literally just an extension of that. It's the expansion of the non-banking world doing banking things in a new way. I mean, you literally own parts of a bank. That's what these systems are. So DeFi is the most short-sighted terminology at this point. And that's okay. It's okay to deprecate terminology, to understand that we've evolved the story and we could tell it in a much more rich way. It's much more than anyone really thinks it is, especially for new folks getting into the space. Hope that helps. Drew, when you find the one that wins, you allocate accordingly. You don't know which one's going to win now. You only know from hindsight. But what you do from a technical perspective, you look for things such as confluence. So you do that from a PA perspective as well. You do that from an assessing the investment, the story, what the protocol is doing, what the on-chain bank is doing. Determinism and immutability. That's what survives until 2030. And if you own 10 protocols that are deterministic and immutable, the software is going to exist in 2030. Now the question is, who's consuming it? And also the risk, does it continue to work as expected? Or does it fail because the software didn't work as expected? It has an issue. It's malfunctioning and no one uses it anymore because it's broken or exploitable. So those are the characteristics that give me such great comfort that I don't have to do a goddamn thing. And in 2030, the shit that I bought, we're going to see what it becomes. And obviously I have my expectations, but my expectations tend to be much more restrained and reasonable as compared to many. All I want is a 10x on the portfolio by 2030. A 10x on my portfolio from here brings me back to all-time high of 2021. So my expectations are probably much lower than what will realistically play out. But from a real world financial need, I don't need anything more than a 10x from here and 20% of the money. I just don't need it. So that's why my expectations are so restrained compared to what is likely to play out. Hope that helps. Dow, David back in the garage, been here since the beginning. Cap, keep going, keep going. We're going to keep doing this. We're going to keep figuring out the path. We know the destination. We're comfortable with the destination, but we're going to see what happens along the journey, because none of this matters unless you can tell a story about what the hell you're doing. Why is it meaningful? And why is DeFi a short-sighted terminology? And why are we investors in literally banks? So that's pretty damn cool. Cap, how can you be sure CVX will survive until 2030? You can't. You have no idea. You have absolutely. It's not like the odds are stacked against you. It's not like it's inevitable. Certainty is not the way the world works. So what you do is, as I said, you spread your chips, and you look for characteristics to spread your chips to create a portfolio that has a good story to tell. 10 protocols, 10 investments, equities, gold, what have you, real estate, 10 investments, and all you need is one to go big. That's it. So you don't know. So you can't say anything of certain about a particular protocol. But we look for the attributes that service us now. Is it paying now? Is it immutable now? Is the code executing deterministically as expected now? Because if it's working now and it's immutable, it's going to continue to do the same thing into the future, mathematically guaranteed. The code can't be changed. So if you place your chips on things like that, you have an increasing likelihood that the portfolio will achieve somewhat of what you're expecting it to in the future at some point. All we're doing by talking, as we're talking and constructing the portfolio accordingly, is trying to skew the odds in our favor. Technical traders talk about all you need to do is win 51% of the time. The last thing any experienced technical trader says is, yeah, I win all the time. Nobody wins all the time. All you need to do is win 51% of the time. And that is enough that you grow over time. So that's the same thing from an investment standpoint. The difference is I don't want to have the anxiety or do the work that so many folks do from a technical perspective or take the risk. I want to sit back and get some damn cash flow. I came late. Did you already talk about FXN? I love the product. Yes, I did, Drew. Check back earlier in the stream. Plenty of reasons to love the product, but technically it is significantly deviated from the average price. And there is absolutely no reason to not expect it to retrace, and it probably will do very well in 2024. So it's another story, and that's from an appreciation perspective. That'd be a capital gains perspective. It's going to produce revenue. It's going to produce the Ethereum risk-free rate, 4-5% or whatever, or maybe at whatever. It's going to produce that kind of risk-free rate. That's pretty cool. The story changes relative to portfolio size. Last couple of thoughts. You got $20 million. 5% is pretty cool. So you don't really need to do anything. So the story changes depending on who you're talking to, and especially depending on portfolio size. 1, 2, 3, 4, 5 million is like a certain category. 20 million is a whole other category. 10,000 is a different category. And the smaller numbers, 100, 200, 300, 400, 500, that requires a very different strategy for capital management. That's more like just accumulation and savings and dollar cost averaging and compounding, and that's cool too. And I hope the vast majority are younger for that, because if you're 20 now and you're saving, accumulating, DCAing, compounding, yeah, check back in 10 years. You'll be 30 years old. In 10 years, I'll be 50 years old. So that's the luxury of being young. 10 years for a 20-year-old is 30 years old. So DCA, compound, save. All you need to save is a little bit of money, and over 10 years, it grows significantly. And by 30, then you can start to make more structured decisions to create a portfolio that has a different behavior and does different things. The 10 grand portfolio is respective of geographics. 10 grand, 20%. You say in certain parts of the world, $2,000 a year is an entire salary. Changes your life. How do you get to 10 grand in certain parts of the world is another story. But that's an interesting perspective. Geographics are a major consideration. 100 grand, 10, 20%, $20,000 a year is a fraction of a salary. That's nothing to sneeze at. 10 grand appreciates 10x over the next 5 years. It's $1 million. Hopefully 10, 20%. It's 100, 200 grand a year. That is a whole salary. So portfolio size and geographics and age tell a very different story for how you could potentially engage from these markets from a capital management perspective. Hope that helps. Let's wrap it up for today. It is a Friday, November 17th at 12:36 p.m. I thank you all ever so much for joining me. It's nice to see interest reemerge for, it's not just crypto. I don't talk crypto. I talk capital management. I talk how I manage money for myself and my family and how I'm trying to meet my expectations for what I want to do with my life from not a retirement perspective. I always want to work, but how I want to service my debts and pay for my bills, my consumer staples, so on and so forth. And it's so important to have this conversation because this is the only real way to achieve really what every single human wants to achieve. I bought ETH at 2K and now it's dropping. Uh, yeah, I'll take a look real quick. 2K was definitely resistance from a 10 SMA and a 3-month perspective. Um, that's why position size, it's not a mistake, nor it's not, you didn't make a mistake. You could have, what you need to do is consider position size. Like if you're accumulating at 2K and it drops to 19, it drops to 18, drops to 17, 16, if you're buying $50 clips, $100 clips, you're DCAing, and that is quite reasonable. But this kind of drop down to 30 doesn't mean necessarily much structurally. From a 3-month perspective, the odds are the price doesn't go much below 1900. You could have a systemic liquidity event which gives us a deviation to the downside, and you see 17. 16 is really maybe it takes a significant event to really deviate from the mean significantly to the downside. 22 was not just a deviation to the downside. 22 was also coming off irrational exuberance. So you had all this velocity, all this momentum to the downside, and it just overshot to the downside. People were so disenchanted it was coming from $4,800 and just kept going down. So there's none of that momentum right now. What there is capitulation, like there's an exhaustion of sellers. This is a very organic market right now, without leverage and without just collapsing sentiment. You don't have the cascade. So feel comfortable that 16. So what does that mean if it goes to 16? It means you could have 400 onto is 20% more. So if it goes down that far, down to 16, you could have had 20% more Ethereum. But on average, in 3 months' time, if it goes to 16, in 3 months' time, on average, the price will be back at 1,900 and change dollars. So that's the power of a 3-month average. These average prices are like a gravity. When you deviate to the downside, they pull back. When you deviate to the upside, they pull back. Give you a 6-month perspective. So unfortunately, on the 6-month, Ethereum is significantly deviated from the mean. So this is why I do talk about Bitcoin from a 6-month perspective. You could have a significant mean regression to the 6-month time-weighted average price, which we did in 23 and more or less in 22. Bitcoin has never gone through the 6-month time-weighted average price. The odds of a mean regression to the Bitcoin time-weighted average price is very slim, considering how much was sold and the sentiment in the market in 2022 to get us to the 3-month time-weighted average price. You could see drops 23, 24. To get to 19 would be just a catastrophic liquidity event. I don't even think there's active supply to sell to get us to there, considering who's the holders and the sentiment of the holders. And what's interesting is you can get a sense of the support in other markets, other places in the market, total stable coins, even at the price of Ethereum, by looking at the Bitcoin chart, because this asset is the collateral of this entire economy. And it will provide support to other assets as well. If it helps, I took a clip of Stargate myself. It was like 2 in the morning. I couldn't sleep. So it wasn't necessarily the best purchase price-wise, but that's fine. I think I bought it at like 59 cents. I thought it was going to hold the daily 200 SMA or the daily TWAP as well, but it pushed below. That's fine. Produces a 15+% APR in my experience, and it's quite comforting where it is from a technical perspective. I like from a weekly perspective that we're above the TWAP. So the whole system should trend in a favorable direction heading into 2024. From a destination perspective, from a path perspective, there could be further liquidity aberrations, liquidity disruptions, and systemic events for all I know. But overall, the structure of the market looks favorable heading forward. Killis, T-A-T-A, everyone, happy weekend, a pleasure. DeFi Futurist, Cap, how can we talk to you? Discord, aren't you on Discord? Pretty sure you're on Discord. When the wars starts again, would that cost? Well, I don't want to get into geopolitics. That's a whole other conversation. The wars are always going on. The world is always at war. There's literally a war in Israel and Lebanon and Palestine, and they're trying to see if they can not get the surrounding area involved. It's an absolute mess, to say the least. And I often don't like to talk about the topic. War is disgusting, suffice it to say. We're always at war. There's plenty of wars going on. So I don't. It's a statement I appreciate, and I like responding to every comment, particularly because everyone's perspective matters. It's a very simplified statement. When the war starts, does it cause prices to go down? Fear causes prices to go down. Liquidity causes prices to go up and down. Irrational exuberance causes prices to go up. And there's plenty of reason for global world war, and that's why we look for confluence. And that's all we have. That's all you can do, is look for pieces of data that support the idea that you have in your head, that give you comfort in your observation. So that's what we've done over the years, and that's what I've expressed over the last, especially a year. That's why we look at this data. We look at this data to find comfort, to let the market play out. And that's why I don't trade on technical data. That's why I buy things and that I want them to pay me. And I just want to buy them at favorable prices. That's why the topic of late is, are you buying at a premium or are you getting a discount? And for the first time in years, so folks that have been around know, it was painful in 22. I wasn't talking like this in 22. I wasn't talking like this in most of 23. But finally, we have a capacity to talk about these charts and liquidity conditions in like a tone and a sense that finally things are stabilizing and things look better than they did in 22 and 23. I hope it all helps. 27 people made it to the end of the stream. 14 likes. Smack that thumbs up button. I appreciate all of you. Tell everyone to subscribe. In the description, link to the most rational community in the entire crypto space. I appreciate everyone, and I look forward to talking with you again next week. Have a good weekend. Take care, everybody. Peace.